Morning, man.
Hi.
Thanks for coming in. So basically today will be about how Stashaway actually works. It's fine to know that it's low cost. It's fine to know that it's very easy because you just download and then deposit. But at the end of the day, how we manage your money and what we actually invest in is the most important thing. For example, why do you watch Netflix and not Astro or TV? It's because the shows on Netflix is good, the content is good. So it's really important that today, for example, we look at the what makes up your portfolio and how we manage the money. Okay, so we call this Stashaway an inside look or a deep dive into Stashaway itself. So I always like to start with the fact that we are licensed. We have a fund management license. So cybersecurity and anti-money laundering is taken very seriously. So
the CMSL
yes,
license.
yeah, that means Capital Market Services license. Yeah.
Any institution that want to take your money
Yes.
as an investment
Mm.
must be regulated here. Must
Yes.
have the license number.
Yes. So Bank Negara licenses banks and insurance companies. Brokers and fund managers are licensed by SC.
Okay. So that means if you have the license, what does it mean to the consumer?
It means that we have the license to be able to manage your money first and foremost. Second of all, if there's anything you feel like you're not happy with the platform or you want to make a formal complaint, you can complain to the local authorities. And secondly, because we're regulated, it also means we need to contribute 2 million paid up capital to get the license. So if anything happens to us, at least there's some pool of funds there to accommodate investors and to make sure that at least there's some funds available for them in the case that we go down. But I think before bankruptcy and all that also, we are doing regular reporting every month, every 6 months, every year to the SC, and they audit us on a bunch of issues, including anti-money laundering, cybersecurity, including our financial position, how our business is growing. Everything is audited. So even before you reach bankruptcy already, we are regulated very tightly.
So to get this license right, the structure needs to follow the format, is it? As in,
Yes.
let's say if I fund money into an account, it definitely the money in the account won't go to Stashaway.
Yeah.
You go to a trustee.
Correct. You'll
account.
go to a third party called a trustee, which opens a bank account with a custodian bank. So our trustee is Pacific Trustees, and they open an account with Citibank.
And this specific trustee must have a
Also has a SC license. Yeah.
license as well.
Yeah, a trustee license. Yeah.
Can you share a little bit about this specific
Sure.
trustee?
Yeah. So a trustee is basically a third party who is independent, who is meant to hold your monies in trust. That's why their name is called trustees. So SC regulates all the trustees in Malaysia, and Pacific Trustees is one of them. So we basically instruct them to open an account with Citibank, and any money that is deposited from an investor goes into this custodian bank, and we cannot touch this money for our own working capital to conduct our own business. But we can only instruct this money to be invested and to be withdrawn.
So you can instruct how this money will be invested,
Yeah.
and you can instruct this money to be withdrawn. But withdrawn to whose account?
Yes, it cannot be third party. If I receive money from you, Meng Teck, I can only withdraw back to your name, Meng Teck.
And this will be this is part of the law and
Yes,
regulation
part of all the regulations.
to get the
get the license, yes.
Okay.
So what you just mentioned is the operational part of getting the license. But obviously they also look at things like, are the people who are running the business fit and proper? So they interview me, they have very strict criteria on who we have as senior management. That's another one. Another one is your financial standing. So that's why you need the 2 million there, minimum at all times. You cannot go below the
But
2
that
million.
2 million is actually for your company, right? Even if your company go bust, it actually doesn't affect the money.
No, correct.
Yeah.
Yeah. But it's there as more of an insurance. But it doesn't touch all the investors' money.
In case they want to fine you or something.
Yeah, you can come
Yeah.
from there. Yeah.
Okay. So in short, we can think of Stashaway as just a fund manager.
Yeah, just a
the
fund
whole
manager.
company is just a fund manager.
Yes.
You only click, let's say,
Yeah.
you only make the fund move around, but you
Yes.
don't actually get control over the fund. Pacific trustee also cannot use the fund.
No, they can't. They only hold it in trust.
Yeah. They only lend you the name, is it?
Yeah, they are a third party. So when we instruct them to do certain things, it can be only as according to our contract with them. So our relationship with them is to say, okay, please send this money to our broker in Singapore, which is Saxo, or please withdraw this money to return it to this investor, and make sure it's not the investor's husband or the investor's mom. It has to be that investor itself. Yeah.
I understand.
Yeah. So this is all very important for the investor to know, because you cannot simply invest in something that is not regulated in Malaysia and expect if it goes down that you didn't make the right move, because if you are invested in something that's regulated, odds are you'll be fine. So as I said before, it's really important to understand how we manage your money. So let's start with how we build portfolios to begin with. So firstly, we use this security called exchange traded funds, or ETFs.
Can we take a shot?
So as I was saying, it's very important to understand what you're investing in and how we invest the money itself. So how we actually build portfolios from scratch is by using this type of security called ETFs, or exchange traded funds. So I'm sure a lot of your community and a lot of your students already know what ETFs are, but for those who don't, basically it's a security that replicates or follows an index or an asset class. So for example, each line over here represented is one ETF. So if you have an ETF that follows the US equities or the S&P 500, for example, we have one ETF to represent that. If you look at, let's say, gold over here, there's also one gold ETF that's represented. So what we do...
Only, for commodity, only gold?
Yes, only gold. And I can tell you why. So firstly, for example, if you look at energy, right, the energy ETF is not best represented because it doesn't follow the ETF, it doesn't follow the oil price directly. It follows oil contracts. And sometimes if oil contracts are already stuck on the lower end, then if oil go back up, then it cannot follow back up. So that energy side is best represented in ETF following oil companies. So it's correlated strongly with oil price, but not tracking the oil price. Bonds normally is not something people own directly because it's very expensive, hard to own. But we have a lot of different bonds featured here to get you not just the portfolio insurance and the coupon, but also in this very low interest rate environment where yields are even under 1, there are certain types of bonds like corporate bonds and international bonds from emerging markets. So we have 32 different ETFs here, and we choose these ETFs based on price meaning how affordable or how cheap it is. The lower the expense ratio or the fee, the better. The second one is size. We really want liquidity so we can go in and out in a very easy way. And then the third thing is thing called tracking error, how closely it tracks the underlying asset that it's meant to follow. So we have a list of 32 here, and any one point in time you will have 7 to 9 ETFs in your one portfolio. And I'll talk about how we will change these ETFs as we go through different economic cycles. Yeah? Okay. So this is just an example of a current portfolio. This is a Stashaway risk index of 22%. Risk index here means you have a 1% chance of losing more than 22%. So sophisticated investors use this metric called value at risk. We also want to highlight risk so that people know what they are getting into. So to repeat, is 1% chance of losing more than 22%. And this is equivalent to a portfolio that is 60% equities and 40% bonds. So like I mentioned before in the previous slide, we use these ETFs to make up your portfolio. And you can see in this one in particular, there's European equities, US equities of different sectors, emerging market and corporate bonds, and gold. So in one portfolio, you already have 1, 2, 3, 4, 5 different asset classes, but even the equity side is broken down into different sectors. Having different sectors is very important because in the upside, certain ETFs will go up more than others, and in the downside, you have protection from others. So in the recent market volatility, for example, small caps and discretionary comms will get hit very badly, but healthcare will still hold its ground. So it's important you have a balanced and diversified portfolio. So this is our riskiest portfolio that we have on the platform. It has a risk index of 36%, so there's a 1% chance of losing more than 36%. This is the riskiest one, and it's equivalent to 100% equities. But I will stress, for example, that you can't compare this portfolio, which is very diversified, to just, say, a pure equity index like S&P 500. While you might get better returns just investing in the one index, the S&P 500, your risk is also very high. So if I tell you, you have on one hand you have the pure S&P, on the other hand you have this portfolio, and the difference in the performance is only, let's say, 2%. But if you're taking 5% more risk on the S&P 500 directly, you actually are not investing well because you're not protecting your risk. You're taking too much risk for your exposure. So that's the confusion that some people make. So because it's a 100% equities portfolio, naturally you'll have a lot of equity sectors like the broad equity index in the US, European equities, emerging market equities, and then different sectors and REITs. So this one doesn't have any bonds, this one doesn't have any gold. Okay, so I want to introduce you guys to what really makes us different from all the other robo-advisors out there. So a lot of robo-advisors will take ETFs, put in a portfolio, and let it run, right? But we go one big step further because we actually have our own proprietary investment framework called ERA, which stands for Economic Regime-Based Asset Allocation. It sounds confusing, it sounds maybe a bit too sophisticated, but really, if you want to simplify it, you want to boil it down, basically, we give you the best portfolio for the best time of the economic cycle. As you and I know, if you want to invest in long term, there will be ups and downs in the market. You will have experience in your life going forward, maybe 6 to 8 different economic cycles. If you want to invest for the long term, you really need to be able to invest through the cycle. So what you don't want is, for example, if you're in a portfolio where times are really good and your market is really good and your performance is really, really good also. But then in a recession or a bear market, after the stock market tanks and you're down maybe 30 to 50%, you just sell and you forget about investing forever. So what we do is to give you the best portfolio for each economic cycle, okay? So we break the economic cycle to 4 parts. The first one is good times, meaning that there's positive growth and there's low inflation. Second one is inflationary growth, where growth is still good, but the inflation is picking up. And then there's recession and stagflation, where there's negative growth, okay? So I'll also walk through with you what are the different asset classes we expose you to during each part of the economic cycle. So just take 2 asset classes, for example. S&P 500 for equities and 20-year government bonds, US government bonds. Naturally, you'll think that I should have a diversified portfolio. I should have these 2 asset classes at least, and then some other asset classes also. But what you will see here is that in good times, equities do very well on average, and bonds are flat. And then in a recession, for example, the bonds do very well, average 8%, but then the S&P is down on average quite a lot. And this 10.3 is not, it's just an average. It's not what we did in the financial crisis. Financial crisis was down 50 over %. So naturally, you can already see that you need more exposure to certain kinds of asset classes in different environments, and what more if you mix in other types of asset classes. So for example, in good times over here, you'll see that we expose your portfolio to more cyclical equity sectors. For example, things like tech, consumer discretionary, and then things like Asia, ex-Japan. If we move into a recession, the stocks which used to perform very well naturally will not perform well in a recession. So we will shift the portfolio to focus more on things like gold, GLD over here, inflation-linked bonds, and also some long-term government bonds. So
how do you shift?
Yeah. So
yeah.
we shift it by changing the composition of the ETFs. So in good times, for example, we will give you ETFs that are more focused towards here. In recession, we will focus on ETFs that are more focused on here.
But what if I choose a 36%
Yes.
risk?
Yes.
So it's entirely equities, right?
Yeah. So if you choose a 36% portfolio, it is equivalent to 100% equities.
Mm-hmm.
But in bad times, when we shift, we will still target the risk level of 36%, but we will shift it to different equities and different kinds of bonds.
So those equities could be commodity or bond linked?
Possible, but I will say, for example, that let's say in good times, we'll give you exposure to consumer discretionary, but then in a recession, we'll give you exposure to consumer staples. And in good times, we can give you exposure to Asia ex-Japan or emerging market equities, but in bad times, we will expose you to European equities. So it's still equity focused because we still want to target that risk level. It doesn't go from conservative to not conservative. It still is an aggressive portfolio, which you still should try and be aggressive in the bad times, especially if you're investing for long term. But we give you a mix of different ETFs. So of course, if we go into bad times, you will have safer type of equities, developed market equities, and maybe some bonds and gold. Yeah, but that's a really good question. So that's good times and recession. If inflation kicks in, we also focus on some other different ETFs or asset classes. Consumer staples do very well in inflationary environment. Also, things like tech surprisingly do well in inflationary environment. And things like inflation-linked bonds, which basically just track the level of inflation so that the yield also goes up in that time. Yeah. And then stagflation.
So bond, right? Like recently there is a federal rate cut.
Mm-hmm.
The bonds will do well, right?
Yeah. So two things. So the yield on a bond goes down, but the prices go up. So when you hold bonds in your portfolio, you will still get those coupons, but your underlying price also will rally, will go up. So overall, when it comes to bonds, it's actually the same as shares in terms of capital appreciation and also getting dividends. But in bonds case, it's a coupon.
It's a fixed dividend.
It's a fixed dividend. But overall, it's much less volatile. Yeah.
But the majority of the gain or loss will come from the difference in the price rather than the coupon.
It depends. So if let's say we are in a very safe environment, right, no virus, no trade wars, then actually the coupon is can contribute more because then your capital protection is there, is very flat. But when we are going through times of uncertainty like now, suddenly people are buying more bonds. So you see the price of bonds also go up. So overall, also when it comes to bonds, sometimes it's about finding the best bond to put your money to get the best fixed return, the best fixed coupon or the best fixed dividend. So for example, in 2018, we were talking about inverse yield curve, right? So inverse yield curve, for those of you who don't know, basically means that the long-term bonds were giving less coupon than the shorter-term bonds. So in that situation, why do you want to lock up your money for 20 years when you can get the same return as maybe a one-year bond or a note which is less than a year, 6 months maybe? So in that situation, we would also use ETFs which follow or which replicate short-term bonds to give you a better return for the liquidity that you have. So with bonds, sometimes it's not just about protecting your assets in the downtime. It's about sometimes maximizing the yield you can get. Yeah. Stagflation is very unique because it doesn't happen a lot, but when it happens, weird things happen to the asset prices because a lot of things become so that the correlation just runs and then it only happens 15% of the time compared to good times and in recession and inflationary growth. So in this situation, all the portfolios that we have in our portfolio will reduce in risk. So remember that 36% I mentioned, in stagflation, we will reduce the risk and actually look at more like at asset classes like gold, for example, that protect you in times of stagflation. So it's little shocks like this, say during the oil crisis in the 80s or even the global financial crisis, where sometimes you need to shift your portfolio for a matter of 1 month to a year when you actually is in a stagflation. Okay.
So this all-weather, right? Have you heard of Ray Dalio? He has a very popular concept called all-weather portfolio.
That's exactly where we get the inspiration from.
Inspiration.
Yeah.
But how is that? There is, of course, a difference of how it works, right?
Yes.
But,
so in Ray Dalio's case, he also looks at economic regimes, different parts of the economic cycle. He breaks it down to like 16 different parts. To simplify, we break it down to 4 parts. But how all-weather works for us is, for example, if the economic indicators that we are getting doesn't point to a very clear area of where we are in the economy. For example, if let's say inflation and growth is near the border, near 0%, then we don't want to anticipate, we don't want to guess, don't want to crystal ball to say whether yes, we are in good times or yes, we are in a recession. So if we are in a border, we will use the all-weather strategy to diversify between these two economic regimes, where you have portfolios here and portfolios here that are weighted the same. So combined, you will also have a portfolio that's more diversified. Yeah, because we don't want to second guess where we are in the economy. Sometimes signs are not so clear. That's why, to stay safe, we diversify into 2 economic regimes using this all-weather. For example, if we are borderline between, say, stagflation and inflationary growth, at that point in time, things are a bit more dangerous. We will actually go all-weather into all portfolios, equally weighted 24% into all. So you'll be, when we don't know where the economy is, we just go super diversified. And then when indicators are pointing towards a very clear part of the economy, then we can go back to this. The beauty about all of this is that it's already programmed. So when we move into these different parts of the cycle, the portfolios that you have will automatically shift, right? Just think of how an active fund manager will also react, right? They will also have to review their portfolio and buy and sell different securities. For us, because it's programmed already, you literally just shift overnight. These kind of moves are called strategic asset allocation. Strategic is basically a fancy word for long term. So in all our years, since starting Stashaway 3.5 years ago, we've only changed asset allocation twice. Yeah. So we haven't really moved into like different parts of the economy. We've remained around here in good times, but we've actually changed it twice because we saw some undervaluation in gold, which I'll talk about later. And then also in August last year, we saw some undervaluation in the European equities, where near Brexit at time, European stocks were getting beaten down. So we overweight into gold and into European equities at that time.
So this is not exactly passive?
Yes, it's not 100% passive. It's in between active and passive. But if you ask me to choose where we are closer to, I would say we are closer to passive. Because 90% of the time is one portfolio. We don't want to churn your portfolio, buy and sell stocks, second guess the system every day. We just want you to remain invested. But then when things change, once every few years, it will just make that switch. So I'll say we are more passive than normal, but we are also not completely 100% passive. Okay. So, okay. We already touched on some parts of this, right? The first part here, the first pillar here was about economic cycles. The second pillar here is about risk management. So this is a little bit more detailed because it's important that you manage risk, and there's a few kinds of risks which we'll talk about, but it's also something that is, for investors, is good to know what is actually going on. But if you don't fully follow, you don't fully understand, so it's okay, but it's also good to know that we manage risk in these particular ways. So remember when we talked about the all-weather portfolios, it's happening here when the economic data is not very certain. We don't know entirely if we are in a recession, we don't know entirely whether we are in a good times. It's in the border sometimes. It's close to 0. 0.1, minus 0.1. Then we go into all weather. All weather here means spread across 2 different economic cycles. So you're even more diversified. The second one is when we see a mismatch between financial markets and economic data. So as you know, financial markets is forward-looking. People will take into account the economic data that they see, but economic data is lagging. 1 month lagging, 1 quarter lagging, 6 months lagging. We also look at some technical analysis to only buy certain securities when they're undervalued if they show certain characteristics, or sell certain securities when they are overvalued if they show certain characteristics. So for example, if we see that, let's just say tech stocks are very overvalued, we will not sell until we see 2 death crosses, right? When the moving averages cross each other twice, then only we will sell, because we don't want to sell too early. And then also on the flip side, where you see something very undervalued, like gold in 2017, December, it was very undervalued, but we didn't buy until we saw 2 golden crosses, and when the momentum already shift up. You all have been investing for a while, you know that the terminology, don't catch a falling knife. You don't want to just buy stuff on the way down in big amounts, then you get hurt because you don't know where the bottom is. So for us, we look at technical indicators to buy or to sell. So that's the risk management part of it. It's all this technical analysis is not really to make huge gains or huge losses, but it tells us what is a good time to enter, for example. Okay, the last pillar here is
enter
really,
as in switch the
enter as in switch, correct.
switch the allocation to overweight stocks.
Yes, yeah, correct, yeah. So the last thing,
but of course you don't do trading, right?
No. It's not on a. For example, if you look at this, you'll see that even though that this happened here, this is multi-year.
Like multi-year.
Yeah.
So before we move on, can I ask, what is the difference between Stashaway and, let's say, unit trust?
I would say conceptually they're very similar. Both either buy equities or bonds or a mixture of both. But here in Malaysia, the main difference is that unit trusts are very, very expensive. I won't say they are.
But maybe you can give some numbers.
Yeah. I won't say they're bad. I'll just say that they are very expensive, because they work using branches and they work using agents. They need to make money, and they need to make money to maintain these channels. So they charge people anywhere between 3 to 5.5% upfront, which means when you enter your portfolio, you're already down, say 5%. Then you need to make up for that difference. Because we are a digital player, we don't work on an agency model. We have no sales charge whatsoever. So if you invest $1,000, $1,000 goes to being invested. And that's very important, because if all your capital, all your model is going into being invested, then all of that money compounds, as opposed to every time you enter, you pay toll 5%. So your performance is actually much less. On top of that, unit trusts have sales charges anywhere between 1.5 to 2% depending on the type of fund. So if you add the sales charge to the management fee, then you'll become something like 5 to 7%.
And every year, what's the fee?
For Stashaway?
Yeah, no, unit trust.
Around 7%. If
every year.
Every year, 7%. If you invest every year, it's 7%.
Let's say if we don't.
If you invest and make one deposit only, then they'll charge you 5% upfront, and then every year ongoing is 2%.
2%. And Stashaway is 1%.
Stashaway is all the fees is 1%, but the most important thing is that whenever you go in or out, there's no sales charge or withdrawal.
For unit trust?
For unit trust, some still have withdrawal charges, some are doing away with it, but also unit trusts have sometimes some hidden fees. For example, if you want to go from an equity fund to a bond fund in tough times, there's some switching costs. Switching costs could be anywhere between 2 to 2.5%.
And how do we decide? Like for unit trust, we decide on our own how to switch, is it?
Sometimes it's at the recommendation of the agent.
Okay.
Sometimes it's your own decision. But I will say that what we make very convenient for you is that switching happens automatically within the portfolio. You don't have to do anything. We will just inform you of the changes.
And unit trusts, do they invest as well, or do they trade also?
So it really depends on the style of the fund manager. So what is for sure is all unit trusts are actively managed as opposed to passive. We talked about passive management just now.
So the difference with Stashaway and unit trust would be it's much more passive compared to...
Yeah, much more passive, and therefore I suppose you don't run the risk of underperforming the index. So if you're active, you die also, you must try to beat your benchmark. You must try and beat your index. So if you look at the data, actually a lot of fund managers don't beat the index on a 5-year or 10-year basis. You want to be consistent.
Even before the fees?
Before the fees also, some underperform. After the fees, I would say a lot more underperform. Yeah. So I think it's what investment style you want to expose yourself to, but active investing through unit trust is always going to be more expensive. Yeah. To be balanced, I will say that there are some good fund managers, but you must do your homework and you must understand where they specialize in. Some of them are very good at Malaysia, some of them are very good at regional, some are very good in China or Hong Kong, for example. So do your homework, and what you should look out for is after fee performance. If your performance is 10% minus your fee, say 5%, your net return is only 5. So are you better off or not better off? If let's say you invest in your returns are in the teens, 15%, then it's actually worth going with a fund manager. So in the end, do you want to pay so much or not? Really is a main choice.
Okay.
Yeah. So to move on to the third part of our era investment framework, to recap, first we look at the economy, then we look at risk management. The third one here is to actually look at valuation gaps. Valuation gaps happen to certain asset classes when in a multi-year cycle, when, for example, in the short term, certain stocks or asset classes go beyond or under their fair value. So we have a fair value assigned to any particular asset class, like in this case it is tech stocks. If we see that it is overvalued, then we will actually reduce the asset allocation. In this situation here, for example, we'll see that that tech stocks are very overvalued, but in this situation here, you see that it's actually undervalued. If it's undervalued, then we increase the exposure. So again, this is not trading because this is multi-year, and you can see that we will only allocate more towards the portfolio or take off allocation from the portfolio if it's 2 standard deviations away from the mean. So we look at gross undervaluation and overvaluation, not slight, because you might see some slight ones up and down, but we only look at very overvalued or very undervalued asset classes. So just to recap, this one is basically about tactical meaning short term. So short term in our world is 1 year, 2 years, yeah, as opposed to strategic, which is like 5 years plus. So we look at tactical asset prices here, where if it's very overvalued, we reduce the allocation. If it's very undervalued, then we increase the allocation. Yeah. Okay. So all well and good with those 3 pillars, but does it actually work? So naturally, because we are a digital fund manager with a certain set of rules, we can do some back testing on how we performed during the economic crisis in 2008. So here you have 3 different asset classes, or 3 different portfolios, sorry. The first one is a Stashaway portfolio at the top. The second one in yellow is a 60-40 bond portfolio, equities and bonds portfolio. And then the third one is S&P 500, pure equities.
So regime optimized balance portfolio is Stashaway?
Yes. Yeah.
But how... This is
which one, right? Which one?
Risk balance.
It is balance. So it is anywhere between the 18 or the 20%
Okay.
Yeah, 18 to 20 portfolio. Okay, so what we'll see after this is actually how the asset allocation switches happen and when they happen and the result of that switch. Okay, so first you start here and we are all in good times, everything is fine. We saw some early warning signs from the Federal Reserve cutting rates and that kind of thing, but you can see obviously that things are still going well. Yeah. You had a question?
This
Yeah.
cutting Fed cut rates, so you will manually switch it from
No.
here?
No.
So the system will.
So these are just events. The data that we actually take into account to switch are things like industrial production and inflation. So
And it will be decided by a human or automated?
So the framework was designed by a human, but it is already been automated into the system.
So it's pre-programmed?
Yes. So
let's
now
say
it's
even
already
if
programmed.
there's nobody
Yes,
there,
yes.
it will switch automatically.
So what happens is that the system will take into account the economic information, and at the investment committee with people, the investment committee, there's 3 of us, we will look at the outputs before actually executing. So ERA doesn't automatically switch your portfolios. It signals to the investment committee to see whether we want to follow what the system says or not. So the investment committee will see what it suggests and then we will execute. So in case something crazy happens to ERA, you have a human layer, humans to make sure the system is performing well and is acting according to how it's supposed to act. Okay, so then in late 2007, we saw the economy change from good times to inflationary growth. So that's when we really shifted, and that shift would involve going from things like consumer discretionary, tech stocks and all that, to asset classes that do well in times of inflation. And these are things like gold, inflation-linked bonds. And then we also saw a bit of stagflation, actually like 6 months later, where we actually shift to say things like tech stocks and things like gold. And then we actually entered a recession in December 2008. So you can see here, if you were exposed to a static portfolio of 60-40 bonds or just the index of the S&P 500, your portfolio will have lost a lot of value by then already. But because we switched, it's actually protected on the downside. Okay, so then after that we returned to good times in August or September this year. So you can see overall within this 3-year cycle that we did very modestly at 10% all throughout these 3 years, which doesn't sound great, but in relation to everything else is fantastic, because you would have gone down 50% if you were S&P, maybe recover back, and then you were down 25%. 60-40 bond portfolio, you're still down 10% in these 3-4 years. So I will say that when you already know the result, you will feel okay or you'll feel fine. But in these very, very tough times, in a recession, for example, in the depths of the crisis, when you're down 40 and then 50%, it's very likely that a lot of retail investors just panic and sell. So what you don't want from your portfolio is vast moves on the downside, huge moves on the downside. Then if you have huge drawdowns, you're going to sell. And you're not going to be able to recover from the V-shape. So we actually smoothen out a lot of the volatility, so you can stay invested all throughout the cycle. And we're showing all this back testing in 2008 because if we go through a recession, that's the real test of a fund manager. Yeah, and a lot of fund managers lost a lot during this time. Yeah.
You have a 10-year chart, is it?
Yes. So this is a little bit more than 10 years. This is from July 2002 until 2018.
But do you have it as compared to S&P 500?
We have it compared to the 60-40 bond index. So 60 equities, 40% bonds here.
Mm-hmm.
Did 8.4% per annum over this span of time. Our balanced portfolio here of 12%, and then this one is 20%, and then this one is 36%. Did 8.5 to 10.5%.
This is over 16
yes,
years.
over 16 years.
16 years, double. So from 100,000 to 500,000. Okay.
In 16 years.
So it's about group balance is 8.56%.
Yeah. Mm-hmm.
This is after fees, before fees?
This is before fees, but the beauty is that the fees is so small. It's only 1%. So you can see every year if we take 1% fees or so, it's still around the same. So for example, if you were with a unit trust and you got 11%, then every year you only get like 5-6%. Yeah, and this is on average. Obviously, there'll be some years or tough times, where you do lose a little bit of money and remain flat. But that's important to stay invested for long term here when you see these huge upswings.
Okay.
Yeah.
The white one will be what?
So the white one is a 60% equities portfolio and 40% bonds. So it's just a benchmark that we use. Each one of these portfolios has its own benchmark, which is risk adjusted. We just put the 60-40 one here because it's the most equivalent to this 12% portfolio here.
Okay.
Yeah.
All right.
Okay. So this is a bit small, but I will show you in a little bit more detail. I'll walk through this slide with you, okay? So 2019 was a great year for our portfolios because markets did very well in 2019. And you can see our returns start at 16% all the way up to 33%. Yeah. And when we use those benchmarks, we tag it according to the risk. So we also beat all our benchmarks. For example, if the Stashaway risk index of 14, you would have done 21% for that year, but your benchmark only would do 15%. Okay, so this is the outperformance here according to our benchmarks. And investing is a long-term game, so I don't want to show you, good returns look like this, therefore please invest. So I will also look at different time frames. Our portfolios started in Singapore 3.5 years ago, into July 2017, and this is the cumulated performance. If you invested for 3.5 years, know that 2018 was a very bad year for equities, right? So also take into account. So that 3.5 years, we did 9.9% all the way up to 29% from half of 2017, 2018, and 2019. This is cumulative. So if you want to analyze, you just divide by 2.5. Okay, so since we launched in Malaysia, so if our investors who invested with us from day one in Malaysia, 2018, the cumulative return is 13% all the way up to 22%. Cumulative, yeah, 2018 and 19. And then this long-term back test for which is 10 years. 10 years is December 2017 to December 2017. It is 6 to 9% per annum. Yeah, this is per annum. So these numbers, these two are cumulative. This one is per annum.
Okay.
Good. So that's it. I just wanted to reiterate that everything is automated. So all you need to do is download the app, deposit money, and what you can do from the app is sign up, deposit, monitor, withdraw, everything all in one app. So you don't need to meet me, any one of our representatives, fill any forms, have any coffee. Everything is done through the app. Okay?
And if they have any question, they just need to click the WhatsApp button and you'll be connected there?
Yeah. So we take customer service very seriously. We hire very good people to not just answer you well in terms of how to fix your problems and troubleshoot, but also to do it very fast. So we have three main ways to seek help. First one is calls, second one is email, but we also include a WhatsApp button here so that you are talking directly to a Stashaway customer engagement representative. They are on hand to answer your questions every working day. So if you ask on a weekend, we'll answer on a Monday. But if you ask on Monday, we will reply by Tuesday. So that is our commitment now. I mean, if you call us, we pick up in 8 seconds. That's our benchmark. 8 seconds, we pick up your call. And then if you email us, we answer the next business day. If you WhatsApp us, we answer in the same business day. Yeah. So multi-channels lah. I think Malaysians need that.
But it's not 24 hours, right?
It's not 24 hours because it's manned by humans, not AI. So, but after hours, you can still email us, and we will respond the next day. Okay, so that's it. I think just to recap, it's super important to understand what you're actually investing in. It's not just about the returns, but it's about the risk and the return, and how we're going about achieving that risk and return. So we use ETFs to build portfolios of different risk levels. We have 12 different risk portfolios you can choose from, and you can also create multiple portfolios. I want to have a long-term, high-risk portfolio. I want to have a medium-term, balanced, short-term portfolio, also can. So you have multiple portfolios. And then after beyond the fact that you can create multiple portfolios, we also manage it in a way that is actually very sophisticated or intelligent. The main thing is that we look at where we are in the economic cycle. We give you the best portfolio for that economic cycle. You shouldn't have one portfolio to go through all the economic cycles in your life. If it's raining outside, you take an umbrella. It's cold outside, you wear a jacket, right? So the same way we adapt your portfolio. And over time, what that does is that it reduces the volatility and it helps you stay invested for the long term. Long term here could mean 10, 15 years. So you're not so emotional in that up and down, right? And if you're not so emotional and you can invest for the long term, your results will be there.
Okay.
Cool. There's 3 people. Our co-founders, our CTO, CIO, and the CEO and myself are on the investment committee. It's chaired by the CIO. Our main job is to look at what the system, and in this case ERA, is suggesting to us, as well as make decisions on when we put these decisions into the portfolios. So there's a human layer between the robot and your portfolios. It's not the robot running the portfolios itself. What we're there is to make sure that the system is giving us the results that is as expected. If there's something that is, we want to enhance the system, it will be done at the investment committee. If there is strange happenings in the financial markets, let's say the financial markets are going crazy, like when Trump tweets something, or there's a geopolitical tension, or maybe there's a virus, then we review all these things to also complement the system. So what's also possible is, let's say the system recommends something. We don't have to, system said this, we must do this today. We can also wait like a month to see how things are going according to certain parameters lah. Because if, let's say, the system wants you to change something, but there's things happening in the financial markets, and we see that it's a detriment to portfolios, then we may not enact it straight away. We may monitor very closely and then enact, say, 1 month later, 2 months later even. So there's still a human layer involved.
Can you talk about the background of the committee? Like, who's the CIO?
Yeah, sure. So the main key player here is our CIO. His name is Freddie Lim. He has a lot of experience in investing, over 20 years on the buy side as a fund manager. He was last global head of derivative strategy at Nomura. What that means is that he goes and sees clients and he uses derivatives to help them make money. He will recommend certain strategies and implement it using derivatives to help them either make money, capital gains, or hedge out the risk. So he is a very, very specialized role. And ultimately, he wanted to go into startups because he wanted to help everyday investors invest like a sophisticated investor. Because he spent all his years servicing institutional investors, high net worth individuals, he wanted something that everyone can access. So when he met our CEO, Michele, who was a consultant by background, who then turned to an entrepreneur when he joined Rocket Internet and was a CEO of Zalora in the region for 5 years. They had the same idea, because the robo-advisory concept is not new, because it was started in 2008, and big companies in the US like Betterment and Wealthfront have started this concept and have started the ETF revolution. So what we did is look at that model and that commercial model, and then put the investment framework on top of it to improve the whole proposition.
The robo-advisory.
Yeah, the investment framework to improve the robo-advisory proposition. Obviously, then you need a tech guy to build everything. So that's where our CTO came in. His name is Nino. Nino is German. All three of them sit in Singapore, by the way. And Nino and his team is the one also responsible for implementing the logic that Freddie gave to them. So Freddie would say, as a fund manager, looking at these indicators and economic data, I would do these things. Tech team, can you help to replicate that logic? And they've built a system that is also automated. So all three of these people and myself sit on the committee, and ultimately we look at these outputs from the system, and we will make that investment decision when it comes to affecting everyone's portfolios.
Okay.
Yeah.
I think I understand most of what I needed.
Yeah.
Okay.
Yeah. As I said, this is all on our website. There's a white paper for everyone to access.
Mm-hmm.
The last thing we want people to think that is that Stashaway or any robo-advisor is a black box. It's important, whenever you invest, whoever you invest, is to understand the investment product and how people make investment decisions, which is why we go to great lengths to communicate this. So I hope that was helpful.
Yeah, it was helpful. Thank you.
Cool.
All right.
Thanks, man. Habis cerita.
Yeah.